Hi there, welcome back to Dukascopy TV. I'm Ben Jones. The estimate for UK GDP remains at 3.1%, the highest levels since 2008. So joining me on the line to discuss what's driving this growth is Professor Kent Matthews from Cardiff Business School. So Kent, there was really strong retail sales data yesterday for the UK, hitting 6.9%. What influence are the retail sales having on recent GDP figures?
Well, you can work it out. Roughly, it's about 2/3 of GDP in the UK is made up of household consumption, of which the large part of that is going to be covered in the retail sales. So, at something like 6.9% growth, you just weight that by 2/3, and you got yourself, a very strong growth in GDP. Of course, net trade acts as a negative drag on it, and so growth won't be as high as 2/3 of 6.9, but it's an indicator that household consumption is growing and the economy is beginning to move.
Now, there was some indication yesterday that members of the Monetary Policy Committee are ready for an earlier than expected interest rate rise. Is this something you see as feasible, especially considering expectations have recently been pushed back by Governor Mark Carney?
Well, I think Governor Carney is really he's got it on his wish list, because he's nailed his colours to the mast with forward guidance, and now even forward guidance is beginning to look jaded because forward guidance was set at 7% unemployment. We're now breached that point, and there's clearly lots of indicators that interest rates should be raised. And one of the problems that Governor Carney has to face is that this is a consumption-led boom. Okay, there doesn't appear to be a commensurate increase in supply, because when you look at these figures and delve into it, what you can see is that these figures are also reflecting an increase in employment, so that GDP growth per person employed hasn't grown that much at all. So that means that there's a supply side problem here. Our productivity is very, very low. It's not increasing. And the reason why it's not increasing is because investment is not increasing. It's essentially consumption that's doing this. Now, consumption growing was one of the factors that got us into trouble in the previous recession, in the 2008-2009. So it is quite important that before the economy gets onto this upward movement, which they'll have to raise interest rates dramatically to curb an excessive consumption growth, it's better to try and do it gently with small increases. So the market is pricing this in. Everyone expects it. So I think Governor Carney is swimming against the tide.
And finally, the sterling is strong at the moment, especially against its US counterpart. Do you think the strength of the currency will fade if an interest rate hike continues to be pushed back? Or is the positive data coming out of the UK at the moment enough to support investor confidence?
Well, that's a very interesting question. I mean, I think that the strength of sterling is based on an expectation of interest rates rising. Of course, there's no way of knowing when that will happen. And so it is entirely an expectations-based outcome. But you're right. If it looks that Carney can credibly commit the Bank of England to keep interest rates where it is for even longer, then sterling will weaken. But the fact that sterling is rising means that they're challenging Carney. They're saying that you don't have the credibility, and we don't think that you will be able to do it because house prices are booming. There are other indicators of growth that are not being matched by supply. So when indicators of growth increase when there's no supply follow through, the next stage is inflation. Okay, so the point is then that is when interest rates will start to rise. So the market's already seeing this, and they're saying that there's no credibility to what Carney's suggesting in terms of forward guidance. So consequently, sterling will remain strong. Now, as regarding investor confidence, if you're meaning that companies that wish to take a long-term view on investment, are they going to be put off by this? Well, I doubt very much, because interest rates surely can't stay at 0.5%, and investments are long-term. They're looking at 3, 4, 5 years ahead. Nobody can expect interest rates to remain at 0.5% for that length of time. Therefore, they already factored that into their decisions. So I don't think, interest rates rising a little bit now is going to disturb any investor confidence.
Ken, thank you very much for joining me again today. That's all from me for now. Make sure you click back for the final day of the trading week tomorrow, though, for plenty more updates from your Dukascopy TV team. Goodbye.